a truly successful investor, it takes a particular mindset. It takes, and there's different facets to that mindset. And, part of it is the whole attitude towards debt, as in, like, some people go, "Oh, I don't want to take on any debt. $1 million worth of debt, that's terrible. It's been drummed into them from their parents, from their grandparents. Oh, avoid debt like the plague. What does that make me, the Grim Reaper or something? Like,
We believe every Australian deserves a right to own at the very least 5 investment properties. I'm Adrian Trimboli.
And I'm Frank Ambezi, and welcome to the Invest in You podcast. If you have enough money to solve a problem, you don't have a problem. Now, this is a great quote, and I love it because when I heard about this quote, it just was a light bulb moment. And in life, we think we have a lot of problems, and which we all do, we're human. But there's times where money can solve that issue, that problem. And so we forget about that. We think that we have to do everything ourselves. But when we can really take the shortcut and get our way to that end result faster and quicker by using money to help us get there. Now, I'm saying blow your money on things that aren't going to help you or push you and get you that result, like on materialistic goods. But I'm talking about, getting there faster and quicker, maybe from coaches, from people that are in the space of any area of your life that you want to, get to a place in time. And as well, if you're stuck in something in your business and you need, assistance, or you're stuck with something with your health, for relationship, you need those assistance. And it not just have to be coaches, maybe it can be some goods or services or something, a product that can help you and get there faster and quicker, and it can shorten that problem and resolve that problem, then you don't have a problem. So I thought it was a really great topic, or a great quote to talk about today, because I think it's really impactful. But enough of this quote. It's a beautiful quote. Take that on, use it. But I think today I want to welcome you to our special guest that we're having on, Sze from MLS Finance, mortgage broker. Today we're going to talk about borrowing capacities. We're going to talk about the economy. We're going to talk about how to increase your borrowing capacity, how to pay down debt faster, quicker. What's the most greatest tools or advice you can get from a broker to help you build a successful property portfolio. And it's just jam-packed with valuable information. I think you're going to get a lot of valuable content today, and I think we're going to do a recap like we always do at the very end. So stay towards the very end after I speak to Sze, because I'm going to recap, give you guys a better perspective as well. But as well, more importantly, if you feel like this is something that can benefit a friend, a family, that someone's about to go for a finance or go for a property purchase, please share this podcast with them, because this is going to help them learn and understand more about property fundamentals, and more importantly, finance, because finance is the name of the game when it comes to property. So stay tuned. So Sze Chuah, the director of MLS Finance, thank you for coming on today.
You're welcome, man. Thanks for having me.
No, it's a pleasure. Now, look, Sze, I've already kind of given the audience a previous, at the beginning of this podcast, a bit of a breakdown about yourself. But if you can just tell the people, I guess, a bit about yourself, about your company, and I guess how it started.
Well, I'm an investor through and through as well. I sort of started my journey back more than a decade ago. I was in a different industry. I was working at Commonwealth Bank, funnily enough, but in IT. So I was a project manager running IT infrastructure and IT security projects. Helped implement some very large systems at the bank, and I just found myself kind of drifting away from that whole IT thing and sort of finding my passion for IT and that industry waning. And I was kind of thinking about getting out. So I started educating myself around wealth and property and investing, and sort of tried a few things. Nothing really went that well until I sort of decided to get into property, and was fortunate enough to start building a portfolio. and found that I was kind of living and breathing property, and eventually that led me into finance, and yeah, opening up my own mortgage brokerage. I took out a franchise with Yellow Brick Road, almost a decade ago, and then after that, formed MLS Finance, and the rest is history, I guess.
So when you started, I guess, your property journey, were there any mistakes or anything that happened with your finances for you to pursue down this career?
Yeah, look, good question, and it did. Like I found that there was such a broad range of lenders out there. Even within like a particular institution. Back then, I was working at the bank, so I just naturally went to CBA to get my finance, and I found that I'd talk to one banker, and they'd say, "Oh no, you can't get any more lending," and then I'd talk to another banker, and they go, "Yeah, we can get you another 2 properties." I was like, how does that work? Like I'm talking to the same bank, and I'm getting 2 completely different answers, and that was one of my motivations into getting into finance, because I felt that there was a gap in the market, and like investors like myself, and I had plenty of colleagues and friends and family who were getting into investment as well, and having a good team around you, like we've spoken about in the past, having a good property strategist, like a buyer's agent like yourselves, a good financier, a good accountant, a good lawyer. I get that feedback that oh, thanks, Z, and like it's great having you part of my team, because I don't have to keep on trying to find the next person to get my loan. I want a lifelong relationship with someone that I knows my situation. I can just go back to them and say, hey, I'm thinking of getting another property, or I need to sharpen my rates, or get some equity out, or whatever it is. Yeah, I guess that was one of the motivations, and I guess that's one of probably the most rewarding things about doing what I do. It's sort of seeing those people go through their journey, and I've been in the game long enough, and getting old enough to start seeing their kids sort of do the same. So but yeah, that's a really that was one of the motivating forces, right? Yeah.
Well, look, you're not getting old enough, mate, because you haven't got any grey hairs, I can see. So you still got plenty of time there, mate. So
Thanks, mate. Diet works wonders.
yeah. So that's why I wanted to ask that question, because I guess a lot of entrepreneurs like yourself, and they start a business because they see a hole in an industry or a certain company, and they can see and they can do something better. That's why I wanted to kind of ask if there was a catalyst, because that's kind of how Adrian and I started our business as well. So I could see there was something that you could see was a hole in, I guess, this industry. It's always talked about, and I guess we got a lot of listeners, viewers that are probably starting out when it comes to building a property portfolio. But I guess can you explain the difference compared to a mortgage broker to I guess a bank, and what the pros and cons are really?
Absolutely. So, especially for those people who haven't used the mortgage broker in the past, we're becoming a lot more commonplace. A lot more people are turning towards brokers. The last statistics that I saw was almost 2/3 of loans originated, last quarter were written by mortgage brokers. And why is that the case? The most simple and straightforward answer is that when you go to your bank, right? Let's just say I bank with CBA. I go to CBA. I go, can you get me a loan? How do you know that that's actually the best product for you? How do you know you're getting the best deal? How do you know that the person that's helping you with that loan is telling you something that's in your interests? And the answer is that you don't, because the reality is that they only have one set of products and one set of policies that they can offer. And when you go to a broker, you potentially have over 40, 50 plus different lenders. So, you have the big four, you have the second tier mainstream lenders like Macquarie Bank and ING and Bank West and BOQ, etc. And you've got a lot of small niche lenders as well, non-bank lenders. So the whole idea about going to mortgage broker is the impartial advice that you're going to get, the fact that we are legally obliged to work in our client's best interest. That's actually part of the legislation that was introduced last year, that we need to demonstrate that we're actually acting in not our own best interests, in the best interests of our clients. So, the bank can't demonstrate that because you're going to the bank directly. So, one big advantage is the legwork. A lot of your clients come to you because they go, there's infinite number of areas in Australia, even in a particular state, even in a particular suburb. There are good streets, there are bad streets, there are overpriced properties, there are good value properties. Which one do I buy? And we're kind of similar in that regard. We'll provide that strategic advice for our clients, especially those that are looking to build a property portfolio, because there's a science in terms of financing a property portfolio. What kind of lenders do you start with? What kind of lenders are going to, and what kind of structures are going to help your borrowing capacity going forward. So I guess that's why people choose mortgage brokers, and people choose mortgage brokers that are experts in particular areas. That could be commercial property, or could be overseas finance, or could be investment finance, like what I mentioned. And that's I guess our point of difference, that we are very used to, experienced in doing all of these types of loans, and we enjoy it. And as I said, we're sort of investors ourselves, so we kind of understand the path that our clients are trying to walk, because we've done that for ourselves in the past.
Yeah, which I think it's really crucial as well, you being an investor, because look, there's a lot of people that are in this game that don't invest and they give that advice, which is nothing wrong with that, of course. But when you're like yourself, you live it, you breathe it, you walk the talk, and so what's going on. You know how to get the best rates, the best, I guess, maximum out of the borrowing capacity, and what LVR to go in at, and I guess how to minimize debt faster and quicker compared to, say, the people that aren't investing in property at all. Because I remember the first time I invested in property, I went to a bank, a Commonwealth, and the borrowing capacity was 400K. I went to a broker same time, and I got a borrowing capacity of 750 from a different bank completely. So straight away, I was like, oh, geez, that's a massive difference. And that gave me the access of getting a different asset and a better quality asset, and just having a little bit more of a buffer, and be able to get into that second or third property moving forward as well.
Especially in today's environment, right? If it's a difference between one or two properties, then all of a sudden your exposure is so much bigger, and you're able to ride that wave of the market, and any increases. So it can absolutely be critical. So I completely agree with you, and I guess that's what we're here for, to really help our clients kind of navigate. Is CBA better than ANZ, or is ANZ better than Bank West, or whoever it is?
That's right. I think it all comes down, I guess, to their personal situation as well, where they're at completely. But
and there's never like a linear answer to that, is there? It just, as you said, it's so specific to not only their situation, but also their goals as well. Somebody wanting to buy one investment property, and every 3 years, it can be very different to somebody who wants to buy 3 investment properties each year. You'd structure them differently in terms of finance, in terms of how much deposit they're taking, in terms of the valuations that we're getting, in terms of the borrowing capacity calculations, in terms of the repayment structure, interest only versus P&I. So many considerations, and every one of our clients is done on a case by case basis, and we take a fair bit of time at the start to really understand what they're trying to achieve, what the property strategy is, and then we tailor a strategy, a finance strategy that works hand in hand with the property strategy that you guys provide, to be able to give them the ability to grow their portfolio.
Yeah, correct. I think a lot of people, they don't have a plan, and a goal without a plan is just a dream. And I think that's what we try to do, and try to, I guess, bring clarity to that vision. Because a lot of people come to me and they go, "Well, Frank, I want to buy a property at 300,000 or at 500,000," and I go, "Okay, what's the reasoning behind that?" And they go, "Oh, it's just my price bracket. That's my borrowing cap. I don't want to just shy just under it." Or they've really got no understanding why. They just come up with this number, and it's, I go, "Okay, what's your plan? What's your goal? What are you trying to achieve? Where do you want to be when you retire? Okay, what's your passive income goal?" And when you start asking those questions, then they start to say, "Okay, it's not just about the 300K property, or or the interest rates. It's about whole lot of things when it comes to building a successful property portfolio," which I think people got to take into consideration as well.
Exactly, and like you said, it really starts with those high level conversations. Hey, that broader, what are you trying to achieve in terms of a passive income? What's your time frame? And working back from there really kind of gives a lot of people the clarity to say, oh, okay, that's where I need to be, because I've got goals of having $500,000 passive income a year in 15 years, and I need to go a lot harder than if I had a goal of $60,000 of passive income a year. And there's no right answer in that. It's just up to your situation and what you want. But the plan could be so different, depending on those things, rather than, like you said, I'll just buy a $500,000 property because, I'm familiar with this area. This is where I live, and that's what I can afford. So
Yeah, that makes a lot of sense.
Hmm.
So look, let's keep moving forward, because we can keep going, and I love this topic of finance. But with a lot of investors, I guess people ask the question, and they say, should I go P&I at the beginning of my journey? And like I said, there's no right or wrong. Or should I go interest only? And they're a bit scared because they're paying down the debt. But I guess it all comes down to, I guess, is the property negative yield, is a positive yield, and what's their goal? But I guess for people to get an understanding of, what's the benefit of going on an interest only at the very beginning of their portfolio, and some of the pros and cons.
Yeah, definitely. Look, interest only can be really, really helpful to a lot of investors, because it does a number of things. First of all, it's really good for your cash flow. So instead of paying 40% higher in terms of your repayments, ensure you're paying down the capital of your loan, or the principal of your loan. It means that surplus cash flow can be used for something else. What could it be used for? It could be, first of all, used to put in an offset account against your owner occupied property, your home. It could be used for the next investment property. It can be used for just day-to-day living, because nobody wants to buy an investment property and then go, oh, I wish I hadn't bought that property because it's really impacting my lifestyle. I feel like I'm having to tighten the purse strings, and my girlfriend or my boyfriend doesn't like that, and it's just never good. We invest for a brighter tomorrow, not like a gloomier today. So the whole idea of interest only is that it gives you a little bit more flexibility. Some people say, "Oh, I don't feel like I'm paying off my loan if I'm not on P&I, and debt is bad." I'm going to argue with that, because when you're taking, there's two different types of debt, isn't there? There's good debt, and there's bad debt, or not bad debt, but non-productive debt. Like when you're taking out, for instance, a personal loan, or a car loan, or an afterpay or something like that. It's not really helping you get ahead. When you're buying an investment property, not only are you buying an asset that's going to appreciate over time, you're buying an asset that is paying you a yield. It's pretty much paying for itself. And also, you're getting some tax benefits from that, especially if you're earning a good income. So by going interest only, you're preserving the good debt, and it allows you the ability to have some more disposable income to put aside to pay down your non-productive debt. So there's a few different reasons: the cash flow, from tax reasons, and just the opportunity cost of that extra repayment. You can do a lot more with it.
Yeah. So if let's say the property was cash flow positive,
Mhm.
now that positive, let's say it's $5,000. That 5,000, does that come added to their personal, income when it comes to their tax year?
Yeah, it does. So if you've found a property that is really high yielding, and it's actually adding to your taxable income, that additional income that net income that your rental property is providing is taxed at your marginal tax rate. So if you're earning over 180,000 a year, and you've got a positively geared property by 10,000, let's say, in an extreme example, you're actually losing almost half of that in tax, because it's being taxed at your marginal tax rate. And the inverse is true as well. If you've got a negatively geared property, and you're paying 45 cents in the dollar at over $180,000 a year, then you get a tax break on that, so it reduces your taxable income. So it's a good point, and that's another way. Getting really strategic advice from you guys, an accountant, from your mortgage brokers, etc., can really help you, because if you've got a husband and wife, husband's high income earner, I'm just using a stereotype, the wife's on maternity leave, not and probably will be over the next few years, not earning much of an income, then it really does make sense to consider allocating a property based on its gearing. So if it's that positive geared property, does it make sense to be in the high taxpayers name? It probably doesn't, right? Put it in the wife's name. But if you've got a growth oriented property that's you're borrowing a lot on, it's highly leveraged, and you're going to get some tax advantages on, and maybe consider putting it in that in your husband's name. So yeah, there can be some really strategic decisions that are made up front prior to you buying the property, and part of that planning phase, like what we were talking about, Frank, that can really help going forward, because most people go, we're a married couple, everything should just be joint, and again, there's some really good compelling reasons to consider alternative ways of structuring it.
Oh, I love it. I like how you said at the beginning, brighter tomorrow, not a doomer today. So
Oh man, man.
it
I
makes a
actually
lot of
just
sense.
came up with that. It wasn't one of those quotes that I sort of Googled and I said, I'm going to use that on this podcast.
Well, I love it. It was perfect. It was perfect. It's so true, and I think I think there's a lot of golden nuggets to stand. So if people listening to this, go back and rewind and listen to that, because it all comes down to your situation, and it's just some good debt and bad debt. It all comes down to your where you are, and what if you got to go on interest only at the beginning to help with your getting that extra cash flow, and it's going to put in your offset account if it's going to go towards the P&I, the personal place of residency. Putting the offset helps minimize the repayments, or if it's going to contribute to property, or just even sit in your own offset account, and as well increase your income as you go along. Because look, we get a lot of clients, and I guess some of them, 90% of them, they need to increase their income. And I guess sometimes the best way of increasing your borrowing capacity, which you can touch on and give us some points there, but I look at it as a positive geared property for the majority of these people. It's going to help with getting that extra borrowing capacity, because that extra income, after all expenses have been paid, that extra cash flow is going to go to their personal income. And then that's going to help them keep moving forward, not get stuck. And I guess going forward, what are some ways, or how you can increase your borrowing capacity? So we know one, I guess, is that extra cash flow positive property. But what are some other tips or tricks for the listeners?
Yeah, there are certain types of because borrowing capacity is really calculated on what you earn. So that includes your salary, any business or self-employed income, any investment income, so rental that you receive, less any commitments that you have. So your commitments are any existing debt that you have. The fact that you have some living expenses to on a week by week basis that you need to factor in, and that in itself is a factor of are you a married couple, are you single, are you living at home, do you have 3 kids, and any other debt. So things like student loans, things like personal loans, car loans, novated leases, afterpays, like what I mentioned earlier. And some of that debt that can be easily kind of manipulated. So if you have those, buy now, pay later type arrangements, and you're thinking about investing, it might be a good idea to consider clearing those. If you're a bit like me, like a credit card points junkie, like frequent flyers, not that we can do much with it these days, right? But like if you have 50K, 100K worth of credit card limit, actually really impacts you significantly. So every dollar of credit card limit actually impedes you by around about $6 borrowing capacity, $6 to $7 borrowing capacity. So if you've got 100K worth of credit card limit, that means you're down about 700K worth of additional borrowing that you could use. So 50K, 350K, etc. So cutting up those credit cards will really help you. Getting rid of those novated leases. They sound like a great scheme, especially when you're not investing in property. No problems. They afford a lot of people a good tax break. No issue with it. But when you're thinking about building a portfolio, when lending starts getting a little bit tight, what people don't realize is they're paying $1,000 pre-tax, $1,000 post-tax a month, and that drains their income by let's call it $2,000 a month, $24,000 post-tax. You have to be earning another $30,000 to $40,000 on top of what you're earning to make up for that novated lease. So it can really impact. So those consumer debt, unsecured loans, all of those things, even as I said, student loans, HEX debts, help debts, they can really take away from your borrowing capacity. So if you look at potentially either paying those out or even consolidating them into your home loan, into the equity of your home loan, even though you're able to, you're still having that debt, the fact that it's actually amortized over a much longer period of time, i.e. a home loan, 30 years, and the minimum repayment so much less, it means your borrowing capacity is going to be a lot stronger. Now, a few other things that you can consider, obviously, medium to longer term, for those people who are really serious about building a property portfolio, it really is about investing in yourself, investing in your own skills, looking for promotion, maybe a higher paying role with a competitor or a competitor's company. Really it's about increasing your own personal income, because that's going to be the biggest differentiating factor in terms of how large and how quickly you can grow a property portfolio. Few other ways, actually, strangely enough, buying property, because taking on investment debt can help you instead of owner-occupied debt. So things like rent vesting, instead of buying a big owner-occupied, can actually help you, because investment debt, $100,000 of investment debt is treated differently to $100,000 of owner-occupied debt, because you get a tax deduction on it, and banks recognize that. It's called a negative gearing add back. They say, okay, well, at the end of the tax year, you're Frank, your you're going to get a tax refund on that. So that's actually going to help your cash flow, and we're going to be able to factor that into borrowing. So the more generous lenders will actually factor all of that in, and therefore you may only be able to borrow, say, $1 million for an owner occupied, but you'll find you'll probably be able to borrow 1.3 for an investment property. So it's actually it's a bit of a different kettle of fish there. So in terms of increasing borrowing capacity, many different ways. Income's always going to be king, but there are some immediate things that you can do to really kind of boost your capacity.
Yeah, there's some really golden nuggets there, and I think one of the things that relate a lot with that is, I guess, rent investing. I have no desire at this point, I guess, to buy that family home, and it gives me the benefit of living where I want to live, flexibility, and I can claim my rental income because I work from home. If you're someone that's self-employed, and you can claim all your expenses that go with the property as well. So it gives you that opportunity to, to increase that income and your borrowing capacity as well, because you don't have that liability. Well,
Yes.
I guess some people, you tell them that your house is a liability and they don't like that, their family home, but the way the banks look at it, unfortunately, they do. And the same goes with actually children, which you probably know, you can agree with that too, where if you have children, that actually shoots all over your borrowing capacity. I'm not saying don't have children. I love to have kids, but it's just what the banks look at. So, if people are looking and they want to, get ahead quicker and they're still young, they have not married or haven't got kids at this point, rent investing, taking advantage of that market and paying off that debt. If you've got credit card debt, card debt and student loans, that's going to even help even more moving forward. And I guess with where we are today, I guess, what do you think there's so many investors aren't successful in today's society when it comes to property?
Yeah, good question. And I personally think it comes down to mindset. I think to be a truly successful investor, it takes a particular mindset. It takes, and there's different facets to that mindset. And part of it is the whole attitude towards debt, as in, like, some people go, I don't want to take on any debt. $1 million worth of debt, that's terrible. It's been drummed into them from their parents, from their grandparents. Oh, avoid debt like the plague. What does that make me, the Grim Reaper or something? Like, these things factor your ability to grow a portfolio and invest successfully. Another one is really the mindset of just delayed gratification. You and I have friends that they like to go out, party, live for the moment, and there's nothing wrong with that. But it will impede your ability to be a successful investor, because there needs to be some sacrifices at some stage. That'll help you, increase your borrowing capacity, make you more attractive to banks, be more hungry and open to opportunity, and be more decisive. There's a lot of things that sort of factor into that. The ability to go through the hard yards and do some planning, the ability to make difficult decisions, and foot out a lot of your savings. A lot of people have saved a large proportion of their life, and they've got their life savings. And when it comes to the crunch, all of a sudden they shy away from parting with it, because they see it as, all of a sudden I'm spending all this money. They're not seeing it as a transference into another asset. They're not seeing it into, going from one asset class, cash, which isn't going to grow, which is, it's actually going to decline in value over time, to a property which, yes, you don't see the cash anymore, but isn't it a better asset because it's going to appreciate it over time? It's going to give you a tax benefit. It's going to open your mind up to other opportunities and have that investment mindset. So, yeah, I think that's a simple question, but a complex answer, because I think it takes a fair bit for people to really not just do it in the immediate, but property is a marathon, isn't it? It's not a sprint. Like you've got to be in it for the long term. You've got to be prepared to have a bit more of a frugal lifestyle. Make a few more sacrifices and compromises, and do it for again that brighter tomorrow.
Yeah, that's for sure. And I think everyone wants it yesterday, but without putting in the hard work. And I think that's why people make so many mistakes. And like mindset is super important. If you want to get anywhere, it starts with your mindset. Like you said, investing in yourself. I think this is why we named our podcast Invest in You. If you invest in yourself, you'll get the result. People want the result, but they don't want to invest in themselves. I think if you just pull back the curtains and first start where you are, and then you're the person laying that foundation and building those boundaries and understanding where you got to go, having that goal is going to help you get to where you are. And I think you got to implement some sacrifice. People want to dance their life away, and that's okay, like you said. But you're on this planet, and look, I remember people saying to me when I was 21, when you're 21, after you're 21, it just click of a finger and it flies by. Next thing you know, you're 50. Like now, I'm 30 years old, or going on to 30 years old next year, and you look back and you're like, Jesus Christ, where'd life go? And then all of a sudden you wake up and you're stuck, and you're like, geez, I danced my life away. And there's nothing wrong with that, each their own. But then of course, that's why we see a lot of people, going and they're working to the 70, waiting for that super, because they have to work because they can't survive and put food on the table. And I think it's really important to people just to focus on themselves, improve that mindset, and start investing in themselves, investing in assets that are going to help them, so have that money work for them. Like you said, I think money in the bank these days, you'll be lucky to get 1% of interest, of that money in the cash. So,
and then you get taxed on it, don't you? So it's you get a 0.3, 0.4% when it's all said and done. But I think you raised a really good point there. Everybody wants the rewards, but not put in the hard work. And I think to a degree, society and media and stuff are a little bit to blame for that, because everybody sort of shows off their highlights. Oh, this guy's a property millionaire overnight. Nobody's a property millionaire overnight. Like it all started with a lot of intent, a lot of that desire to build something, and then going through that planning phase, like what we were talking about earlier, and then figuring out your finances, figuring out your team, your strategy, and figuring out where to buy and how you're going to get ahead, and then you sort of start buying the property, and then you get one property, and then you save up for the next property, and then you use the equity from those two to buy the next one, and all of a sudden yes, you've got 3 properties in 2 years, but that took 5 years. That didn't happen overnight, right? So I think people underestimate the whole planning and that sort of mental fortitude that it requires. I think we wanted to really highlight that. And yeah, it sounds like we're a bit killjoy-ish, but it's true. It's a marathon rather than a sprint.
Yeah, definitely. You got to plant the seed, watch it grow, and be patient with the process. It's like going to the gym. People want to go, then get gains straight away. It's not going to happen like that. It takes repetition. And so it comes with your portfolio, making sure that you're always keeping up to date with your interest rates, and making sure you're getting the best rate, and making sure you're keeping update with your property, maintenance, and, doing checks on yourself as well, learning, growing. I think it's the number one thing for myself. I can talk is, you probably read Rich Dad, Poor Dad, and all the other financial books out there that were the spark or the catalyst for taking a change or in your life. And I think, if you just do those small little things and improve every single day 1% better, you can get that result that you desire to achieve.
Exactly right. I couldn't agree more, and couldn't have couched it any better myself.
So I want to keep moving along with I guess different. So we've got different loan types. So for the listeners, we've had a lot of new investors coming on, and they've got their new business, and maybe they haven't got the financials of 2 years of invoices. So you got a low doc and you got a full doc loan. And I think it would be benefit to explain to the listeners and viewers, I guess, what the difference are, and maybe start with full docs and then go down the low doc and the benefits of, both of these loan products.
Yeah, definitely. So in answer to your question, like a standard loan that, you go to the bank and they go, okay, well, show me your pay slips. Oh, you're not a PAYG. You're self-employed. You run your own business. Okay, no problem. Show me 2 years of tax returns, financials, notice of assessments, balance sheet, etc. And we'll lend on that. And like you said, a lot of people are new in business, or they've changed structures, or they've gone from employed to self-employed. They're still in exactly the same industry. So a lot of some lenders recognize that. A lot of the mainstreams, especially with all the reforms in finance over the last few years, things like Royal Commission and APRA and Sedgwick and all of those things, a lot of the risk has gone out of the top end of town. So the majors and the mainstream lenders, they used to do low doc loans, but now they go, no, just show us 2 years returns. I don't want to know anything else, right? But a lot of smaller lenders still recognize that there's a need in the market for all of those people that we've spoken about, those people who aren't necessarily up to date with their tax returns. Maybe it's a business that takes a lot more cash profit or revenue rather than declaring everything. So there's a recognition of that, and that's what they came up with, and it's been around for years, and it's probably coming, making more and more of a resurgence, especially with COVID and businesses being impacted and so forth. Where low doc loan says, okay, Frank, you work for yourself. Show me your tax returns. Oh, you don't have tax returns. Well, how are you going to prove your income then? How can you prove how much you earn so I can lend you some money? And you go, oh, well, my accountant can vouch for me. Like, I've used him for years, and he knows really how much I earn and the trajectory and the business structure and stuff. So that's one way. So a low doc loan, you can go to your accountant, they can sign a declaration around how much you earn, and then away you go. Another way is having a look at your bank BAS statements, right? So every quarter, it's a great time for us self-employed people, isn't it? We get this whopping tax bill, and we have to pay installments and do all this.
Right.
Yeah, it's terrible. But with these BAS statements, they'll say, okay, well, that'll show me how much you earn. I mean, just give me your last 4. You've been trading about a year. Give me your last 4, and then I'll take that into consideration. Another way is your business bank account statements. So, who do you bank with? Show us your last 6 months history, and then we can see the credits going in there, all of the income coming in. We won't worry too much about the expenses, because we don't know whether that's you paying yourself a salary, or inventory or stock, or capital expenditure. We don't know. We don't really care. So it could be any of those. It could be a number of those. It could be multiple of those, instead of showing your financials and your tax returns. So that way it gives you a lot more flexibility. Now, you asked about the pros and cons. The downside of that is that because it's a little bit more risk to the bank, isn't it? Because you're not showing them everything. That's why it's called low documentation. It's a little bit more risky, because if you had a really good relationship with your accountant, or if you had a couple of good quarters in your BAS, you could potentially get a lot more lending. That's why the banks generally charge more for their low doc loans. So in terms of fees, your incoming fees are a fair bit higher. You might pay a risk fee, which is similar to LMI, or lender's mortgage insurance, and you are likely going to pay a higher interest rate as well. There are other things that are restricted, things like how much deposit that you put down. They usually want you to put down 20%, if not 30% for a low doc loan. So there are constraints around it, but certainly there are some situations where it works really, really well, and it can be the difference between getting that property and not buying the property. So can be very, very worth considering.
So eventually, I guess everyone will hit a ceiling when it comes to lending at a full doc. So then, yes. I guess a way around it, even if you're an employed person, PAYG, eventually probably some of those people, if they're investors and they're aggressive, you probably have to go down, I guess, a low doc to keep that going. Because mistake me if I'm wrong, but people think there's a ceiling, and you hit that ceiling, and that's it. You can't borrow anymore. You're stuck. You have to wait, and maybe you have to wait because you have to pay down debt or whatever, get a high income. But if you've got I guess you've got the income, but you haven't got the statements, or if you're maxed out because you can't increase your income now, but you've got cash in the bank. I guess you can always go down that path of low doc, and there's always a further point moving forward.
Yeah, to your point, I think you're right. There's often another way, rather than just going to the bank and they go, oh no, you can't borrow anymore. First of all, different banks calculate how much you can borrow differently, so there can be a market difference up to 30% in some cases in terms of how much you can borrow between banks, and then bring into that non-bank lenders. So the non-deposit taking institutions that are still governed and still have a full financial or credit license, can lend out money, but and are legitimate, have been around. Many of them have been around for years and decades. Low doc generally is reserved for those people who are self-employed, who have an ABN. So if you are planning to get into business at some stage, it's always a good idea to open up your ABN or your company sooner, and then start running a little bit of income through it, just to get yourself started. But in answer to your question around the ceiling, there are certain other ways of increasing your ceiling. Nobody has an infinite borrowing capacity, but there are certain ways, like structuring an interest only is a good example of that. Some lenders, if you're able to get interest only across your portfolio, some lenders will lend you a huge amount more than versus if you're on principal and interest. So if you can fix in maybe some interest only, and then you max out with the banks, you can go to some other lenders and they'll say, okay, yeah, we're happy to. The banks won't lend to you, but we'll give you another property or even another couple of properties. So there are certainly ways and means. There are there's the opportunity to buy in trusts and buy commercial properties using the income from the lease, and known as lease doc, similar to the low doc, but they're not going to look at whatever else you earn in your own personal name or outside of that entity. And they'll just go, oh, that's a pretty solid lease. It's running for another 5 years, 7 years, 10 years. We'll give you a lease doc loan where we just have a look at that lease and we're comfortable with that. So it can be really painless and straightforward and again increase your capacity to grow your portfolio.
Yeah, that's another topic I think we'll get you back on and talk about that lease stock and I guess investing in trusts and I guess the advantages of how it can do with your borrowing capacity, because it's another kettle of fish. And
it is yes. We can talk for many hours about that, and the pros and cons, and why people consider it, and why it can be a good idea. The downsides of it as well, because whilst it can help, it can also hinder, because some people, some lenders don't like lending to trusts. They're very vanilla. They go, oh yeah, trust. We don't deal with that, and that passes you up. So, yeah, absolutely. Let's put that one in.
Definitely. Look, we've covered a lot here today, which your wealth of knowledge is there, and I appreciate it because you've given, I guess, a lot of people perspective and I guess some tips and tricks as well. So I want to kind of get towards now, I guess, the big question that I get asked a lot: where do you think interest rates are going? What's going to happen in the future? Look, we don't have a crystal ball. Okay, so we can't take this as a financial advice of what Z's about to say, but we can all have an honest, a general opinion of what we think is going to happen. What do you feel is interest rates going to rise this year, or what's your predictions? Is it going to be a 2-3% rise? Whatever I'm thinking, what do you think is going around the corner or coming this year?
Oh, good question. I mean, like you said, there's just so much uncertainty out there, and but one thing has been apparent, that there's a lot more whispers that are sort of becoming murmurs, that are becoming louder voices around an interest rate increase this year. Some people are saying as early as August it might happen. Reserve Bank's still holding out and saying, yeah, it's still at least another year away. Conversely, quite a few commentators are saying, yeah, certainly not at least until next year. The reality is that we literally don't know. I think going back 6-12 months, it was a couple of years away. Given that the recovery from COVID has been a lot better, and the impact of COVID on the economy and certainly the property market hasn't been anywhere near what anybody expected. When we had the first round of COVID, the banks were coming out and saying, look, the property market's going to drop by up to 30%. Did that happen? No, it went actually the opposite way. It went up by 30% plus, right? So that's one of the things that they will factor in. They want to have the banking sector and the government around the banking and real estate sector want to make sure that there isn't a huge crash. So, is interest rates going to go up 2 to 3%? I would say absolutely no time soon. Could it go up, by a smaller proportion, maybe 0.25%, 0.5%? Absolutely. And we're obviously referring to the cash rate. The Reserve Bank sets the cash rate. Interest rates in the background, so for lenders, have already been going up. So the fixed rates have been gradually creeping up for the last 3 months, 4 months. They've just had another round this week. It almost seems to be a weekly recurrence where at least one of the big four is popping up their fixed rates. So there is almost a full consensus that rates are on the way up. Like you sort of touched on, the question is when. And my view is that if it's not later this year, then it'll likely be early next year, but it'll be like a softly approach. The government's not going to want to see the property market come to a screeching halt. But having said that, they don't want to see another 20% a growth year on year. That's just not sustainable. So it's a fine balance that they're trying to kind of tread. They don't want to kill business. We've seen the share market take a bit of a hit, and same with crypto recently. So we just don't. They're not going to want any like sort of knee jerk. It's just going to be sort of quite softly done, like they've done over the past few years. And like the government gets a lot of beating, doesn't it? Like you'd hate to be a politician. You can't, whichever way you go, you're going to get copper bruising from some direction. But I actually think from an economic perspective and a banking and finance perspective, they've done a really good job over the last few years. It's been far from an ideal environment for economic growth. But there's been support packages. There's been strategic tightening of finance, not too much, but just enough, just so things don't get out of hand, but not too much so that it doesn't get we don't go into the doldrums. So I think we just expect more of the same. They don't know what's happening. We don't know what's happening. So we'll just play it by ear.
Yeah, definitely. I think you just keep an eye on what's going on in the markets. I think that's the number one thing an investor can do. Not take the hand off the pulse, see what's going on, have a look at the cash rate, have a look what's going on in articles, and I think just seeing just having a clear vision. Because look, if interest rates do rise, the big question I get asked a lot is the property market going to crash? Is it going to slow down? Which I don't think it will, because if we look back from 2008 August all the way up to 2009 August, in 1 year, the cash rate went from 7% to 3%. Can that happen again? Who knows? But in that time frame, there was markets that were booming, and there were some markets that might have been slowing down. And some of those markets could have been, which were actually some of the mining towns were starting to see some growth, and then actually started to see the other way around, where they say it's some decline as well. So it's just you just don't know what's around the corner. But I guess with what's going on, I think they need to get the economy, turning. And I think they're not going to, if they do raise it, I don't think it's going to be a 1 or 2%, like you said, straight away. It's going to be something that's slowly incremental. Because if it did, I think, and mistake me if I'm wrong, there's a lot of people that have gone out there, and the whole market's being dominated by first home buyers. And a lot of those people I guess they're probably hit close towards their maximum borrowing capacity. So they're right there at the limit. If they did go to 1 or 2%, and interest rates jumped up to that, it's going to affect a lot of people. And I think we start to see a housing crisis of, not be able to pay those home loans, and there's going to be something going on. And I think the economy can really suffer from that. So it's just a delicate game, and I don't think it's going to happen anytime soon. I think it's going to be a slow proceed up moving forward.
I think so. They'll sort of step it and then monitor a little bit, step it and monitor a little bit. I think that'll be the same with the availability for funding and finance. They're going to sort of make it a little bit more difficult. They'll sort of tinker around the edges. They'll increase the servicing rate or the assessment rate, and just by a little bit, they'll just raise the floor a little bit and see how it goes. And they've done that. About 6 months ago, they started doing that. So it's going to just sort of continue. I don't think there are going to be any knee-jerk, especially coming up with the election coming up as well. So nobody's going to want to fall out of favor and do anything drastic. Once that's done, it might be a different story depending on how things go from now to then. But again, it's just suck it and see approach. And like we were sort of saying earlier, regardless of the environment, regardless of market conditions, whether it's a hot property market and prices are increasing, or whether it's things are tight and there's not much happening, I think you'll agree that there are always opportunities. If you bought last year, it was already a hot market last year. A lot of people were saying, don't buy. But what I do know is that there is a cost of not making a decision, right? And I have a few clients, not a lot, but I have a couple of clients that it's a heartbreaking story, because 5 years ago, they started talking to me and they were saying, "Oh, Z, I want to buy my home. Yeah. But I don't want to pay $1.3 million, right? I don't want to, that's just too much money. I want to pay about 1.1, and the market just went and went and went. And then I'm talking to them again last year, and they're like, okay, I've got to bite the bullet. We'll pay 2.1. and that's a big cost, and the cost is real. That's the hidden killer. People don't factor in the whole opportunity cost. There's a cost of not doing something, right? So again, that question of what goes back to being a successful property investor. You've got to be opportunistic. You've got to be able to thrive regardless of the market conditions. Are interest rates going up? Great. I'll factor that into my own cash flow. I'll fix my rates. I'll buy a high yielding property, whatever it is, right? Or interest rates are coming down. Great. There are more opportunities around in the market. So you need to be a little bit more positive around what's going to happen and what your capabilities are in order to cope and mitigate that risk. And so, I agree. Things are changing. Be informed and be educated and listen to opinions and, look at data. But ultimately, at the end of the day, there's also an element of faith, because, as I keep on saying, none of us really know exactly what's going to happen tomorrow, next month.
Yeah, it's very true. And I think, like you said, opportunity cost. People sit there, wait on the fence, Next thing they know, oh, I could have done this, I could have done that, and they've seen that property, skyrocket, double in value, whatever it may be. And then, maybe it might be too late, or maybe, they're running out of time, and it's just, getting harder for them depending on what age or where they're at with their journey.
Exactly. And there's a big negative impact on that, isn't there? Like, people just go, oh, I should have bought that property. Oh, I should have bought the other one. And then they sort of start beating themselves up, and then you have that opposite effect. They become very kind of even more risk averse, and even more kind of beaten down, and they're even less open to opportunities. So I think a lot of it comes back down to the mindset, and it becomes self-fulfilling in a way.
Yeah, for sure. And I think a lot to do with this is, look, I'm based in Melbourne, you're based in Sydney, and I guess people look at those markets and it's unaffordable. And they're waiting for this crash to happen, or so they can get into those markets. But if we look, Australia's a big country, there's over 15,000 suburbs. And a lot of those suburbs some of them, they're A-grade class investment material. And so some of those suburbs are very affordable. I think people, if they just open up their eyes and educate themselves and get a team around them, they don't have to buy in their backyard. They can buy, in places where, there's affordability from 250,000 onwards. And I'm talking about houses or blocks of units, whatever it may be. And, you're just not looking, with I guess a fixed mindset, having that open mindset of looking around, asking questions, educating yourself. So, which is super important. And so I want to leave it with the next question, which is, what should, I guess, an investor be focusing on? What's some, I guess, maybe top 3, or if you've got 5, what should we be focusing on, I guess, when it comes to finance, when it comes to, I guess, investing moving forward?
Yeah, first of all, is that team, are you getting that right advice? Is your lender, broker, banker giving you the advice that you need, the service that you need around what you're trying to achieve? Another one would be, are you structured correctly? So are you introducing any risk into your situation? I'll give you an example. Somebody came to me, and they were very successful. They were an executive of a software company, and they had quite a large portfolio already. They had about 10 properties, quite significant properties. They were like, oh, just gotten my next career advancement opportunity. I want to keep growing my portfolio. But then I had a look at their portfolio. They were with one bank, and they were all cross-collateralized. And what that means, in short, is that there was, loans that spanned multiple properties, meaning that they were basically locked in with that bank and locked in with those loans. Banks love them because they've got control of your assets. But it introduces inflexibility and introduces risk into your portfolio, because they're like dominoes. If one goes down, then all of a sudden the others are all at risk. So what
do you mean by that? So just for the viewers or listeners, what do you mean if one goes down, they all go down?
So let's just say you have trouble paying one off, and you've got one loan that's securing 3, 4, even 2 properties. If you run into financial trouble on that property, under normal circumstances, quite conceivably, you could just sell that one, offload it, and it would be a lot easier, an exit strategy. But if you're cross-collateralized, if you're linked in with all of those other properties, then all of a sudden the bank goes, oh, no, hold on a sec. I don't want you to just sell that. I might want to revalue another one. Maybe you should sell that one. Or actually, you know what? There's no equity in that investment property that you've just bought, because you just settled on it last year. But there's plenty of equity in your home. I might take that one, thanks. And that would be a terrible scenario, wouldn't it? I personally haven't seen it, but it is written in the contracts that they have remit on whatever properties that the loan secures. So you've got to be really careful around the structuring. And again, this is a topic we can spend days talking about. but it's an important one. Another one is tax. Are you set up correctly? Because a really important component around investing and consideration around investing is tax. A lot of people pay a lot of tax, and it's great for the country, and provides for our schools and our roads and hospitals and so forth. But the reality is that nobody wants to pay any more tax than they need to. And by investing, there's certain things that you can do in terms of repayments, in terms of how much deposit that you put down, in terms of ownership, in terms of shifting debt around, that you can do that's going to really make a massive difference in terms of your taxation. So if I was to name three, it would be taxation, it would be risk, and it would be the other one that I can't even remember that I've talked about.
Team. I think you had team there.
That's it.
Don't worry, I'm taking notes here. Well, look, it's been a great session. So I want to leave you with the last question.
Sure.
Can you save your way to wealth?
No.
Great answer.
Yeah. Look, my parents are an ideal case study of that. Nobody saves harder than my parents, right? Every penny and every cent that's available, there are tissues that are cut in half, and there are buckets of waters under the sink, and all sorts of measures to save every cent. But the reality is that my parents didn't own any investment property, and they invested. Like, my mum likes to invest in shares a little bit, and that was probably the only thing that really provided any sort of wealth for her. So if you think about your own situation, let's just say you earn $100K a year, right? And how much can you save after paying your rent or your mortgage or whatever it is, after your living expenses? You can earn 20, 30 grand, save 20, 30 grand a year over 10 years. What's that? 300K, right? Over 3 years, 30 years. If you save your whole life, your whole working life, you might be able to come up with $1 million. $1 million now, $1 million 30 years into the future. We know what's going to happen. $1 million 30 years in the future is not going to buy much at all, right? So, in short, you need to have assets grow for you. We work really hard for our to earn the money that we earn, but it's got to be constructive. It's got to be put towards something that's going to work for you when you sleep. And saving in a bank, like what we were saying, it's going to be eroded by inflation. It's going to be worth a lot less than it was last year, 5 years ago, 10 years ago. So the only answer is really to invest in assets that could be businesses. So it could be shares, it could be crypto if you know what you're doing. It could be property. My vehicle of choice is property. I do have a few other investments in various areas. I bought a whole heap of crypto recently. It got completely smashed. And look, and my mum manages my share portfolio, which is probably getting smashed as we speak. Shares are getting smashed. But my investment of choice has always been property, because I genuinely believe Australia is the absolute best place in the world to live. And we've got the best schooling, we've got the best weather, we've got the best combination of all of those things, and the demand for housing in Australia is only going to continue to increase, and COVID has shown that. So property to me is an amazing way. If you find a different way, if you believe in crypto or shares or whatever it is, great. Forex, forwards, futures, whatever it is, commodities, go down that path. Pick something and really specialize in it. There's a lot of a lot of financial planners say, oh, you need to diversify. You know how you need to have asset classes. And I couldn't agree with that less. I couldn't disagree with that more. One of those. I don't agree with that, because you've got to start somewhere. You've got to be good at something, be able to create like wealth, and then you can really sort of implement those measures, right? Once you've got something to diversify, once you've got a big portfolio, once you've got net wealth of 5 mil, 10 mil, 50 mil, however much it is, then absolutely implement those principles. But to get to there, how do you, like, for the average, everyday Australian, how do you get there? You need a vehicle, right? And again, choose your vehicle. If it's property, then you know how it is. You need to study it. You need to have, you need to live and breathe it. You need to educate yourself. You need to surround yourself with similar-minded people, and really sort of go all in and really get into it. Invest yourself, and grow your portfolio. And if you're in it for the long term, then it'll minimize your risk, because I guarantee you, if you buy a fair amount of property in different areas, good quality properties like what you show your clients, in 10 years' time, 15 years' time, you're going to end up significantly ahead. So that's just my philosophy. That's how I've always kind of lived my investment life, and that's how I'm going to continue to live my investment philosophy.
Yeah, it's. I think what's the Albert Einstein? The compound interest is the eighth wonder of the world.
It's so true.
It's so true.
And nothing compounds more than property, right? Like, you can buy, $10,000 worth or $100,000 worth of Commonwealth Bank shares, right? And we're beating up CBA, sorry guys, today, but like, but they'll actually lend you 90% on a property. So they'll lend you, $1 million for that 100,000. So your compounded growth is against that $1 million, not against that 100,000. So that's what makes property so amazing, because the guys who really know what they're doing, they are backing the property market. The banks, they go, and they know money, right? The banks know money. So that if they're willing to lend you 90%, 95% on property, is that a reasonably safe investment, over the long term? I have always thought it is, and I will always think it is.
Yeah, plus you get the tax advantages, which people don't look at. But you invest, of course, for wealth when it comes to property. But you got the benefit of tax advantages, depreciation, all the rest of it that comes with it. But I think one of the keys that you said is, we listen and we see these people talk about diversification. So they might buy a property or two, and then they go off and they get into stocks, and then they go off and they get into crypto or commodities, whatever it may be. But what you said was very important. It's become successful in that vehicle, invest in that vehicle. And then when you've got a net wealth of, if it's 5, 10, whatever it may be, $1 million of assets, then maybe you go into a different diversification and start implementing into that. I think people look what's going really hot now at the moment, and then they all maybe invest in property. Then, you know what, let's go on the stock, let's go into the crypto.
Dabble a little bit.
Yeah, so super important to just focus on that one, be great at that one thing, and then move on. You can't be, what is it, the jack of all trades, master of none. So it's important to make sure you just have that one asset you focus on, because you can be super, passionate, but not really passionate, successful in that area, and then move on to the next one once you feel like you've conquered something in that vehicle.
Exactly. You're right.
So look, Sze, I appreciate today.
No worries. Thanks for having me.
It's a delight.
Yeah.
Where can the viewers and listeners find you? I will definitely put in the bio, but just, a little plug for yourself.
Oh, thanks, man. MLSfinance.com.au and LinkedIn or our Facebook. Shoot us a message, and we'll be sure to get back to you. So thanks for having me again, Frank, and Adrian. We'll be delighted to be back to talk about part 2.
Definitely. There'll be a part 2 series coming out. We'll talk about all the other, I guess, more advanced finance details and moving on. So for people that get more educated moving forward, we can tap into those areas. So it's been a pleasure, and thank you once again.
Thanks, Frank. Cheers.
So there you have it. We have Z from MLS, a wealth of knowledge. So I suggest you rewind this, go back, listen to this again, because there's some really, really good, snippets here, golden nuggets. We talked about a whole bunch of things. We talked about, I guess, what investors should do. What's their main focus? He's got team, the correct structure, minimizing that risk, and I guess tax minimization. Putting those, that asset in the right, correct order, so you can help yourself and benefit from the rewards of investing in property. We talked about, I guess, why most investors aren't successful in today's society, and I think that the nail on the head is mindset, and not having the right, correct mindset when it comes to investing, thinking it's just easy investing in your backyard, not wanting to grow or learn new things, and just being fixed minded, not having a growth mindset. So I think that was really impactful getting into that. And we talked about, I guess, loan structures. Loan structures as in low doc, full doc, and I talked about how to increase your borrowing capacity. So there's a whole number of things, minimizing those or reducing the credit card debt, paying down the card debt, student loan paying down, your living expenses, cutting down, or increasing your income, which is probably the number one thing, or getting properties that are cash flow positive, that are putting a positive cash flow surplus that's contributing to your personal income. So it increases your income, which is super important. Rent vesting, the benefits of rent vesting and how can it help you with your borrowing capacity. The importance of interest only versus principal and interest, and why it's important maybe to go on it interest only at the very beginning of your investment journey. There's a whole bunch of sneak peeks there. So go back. I'll put Z's details in the bio. If you want to reach out to him, reach out, tell him, Fresh Start Advisor, you listen to the podcast and he'll look after you. He's got a wonderful team, great team around him, and it'll help you get the right advice tailored to your personal situation.
If you like today's podcast, then you're absolutely going to love the InvestInYou Facebook group, where we share a bunch of valuable tips and tricks on property investing for our exclusive community. Come join us and let's level up.